You know, there's this common belief out there that when you start getting benefits from your long-term care insurance, all that money is totally tax-free. It's a really comforting thought, right? But, and this is a big but, it's not always the full story. The reality is actually way more complicated, and if you misunderstand it, you could get a really nasty surprise from the IRS.
So that brings us right to the heart of the matter. The big question we're tackling today: are my long-term care benefits always tax-free? The short answer? Nope. And we're about to dive into exactly why that is and what you absolutely need to be looking out for.
So on one hand, you have this widespread belief. LTC benefits are just tax-free money, kind of like a payout from a health insurance policy. But the reality? Well, the reality is more like a minefield of critical exceptions. And if you step on one of those mines, it can turn what you thought was your financial safety net into a huge, unexpected tax bill.
Okay, so here's our game plan for figuring this all out. We're going to start by busting the tax-free myth. Then we'll get into something called the per diem trap. This is a big one. After that, we'll learn how to decode the IRS form that kicks this whole thing off, the 1099 LTC. Then we'll cover the dangerous double torpedo effect, and we'll wrap it all up with a clear, tax-proof action plan you can use.
All right, let's jump in and tackle this myth head-on. It all starts with a specific rule in the tax code that gives us this sense of security. But the trouble really begins when a certain little form shows up in your mail.
Now look, this idea of tax-free benefits didn't just come from thin air. It's actually rooted in the law. Specifically, Internal Revenue Code Section 7702B. This is the foundation. It says that benefits from a qualified long-term care contract are generally treated just like payments for a personal injury or sickness. And what does that mean? It means they're not supposed to be part of your gross income. This is where all that confidence comes from.
But then, this thing arrives, a Form 1099 LTC. The second your insurance company sends this out, they're flagging it for both you and the IRS, basically saying, hey, just so you know, a payment was made over here. Now, it doesn't automatically mean you owe tax. What it does mean is that the clock is now ticking, and the burden of proof is officially on you to show what part of that money is tax-free.
So how in the world does this supposedly tax-free money suddenly flip and become taxable? Well, the number one culprit is something I like to call the per diem trap. Let's unpack that right now.
It really all boils down to what kind of policy you have. See, a reimbursement policy is pretty straightforward. It pays you back for the actual documented costs of your care. You spend it, you show the receipts, you get the money back. Simple. But a per diem or indemnity policy works differently. It pays you a flat cash amount every single day, let's say $400 a day. It doesn't matter what you actually spend. And that is where the IRS gets much, much stricter.
Okay, so the IRS has a specific test for these per diem policies. Think of it like this. The IRS gives you a tax-free allowance for the year. And that allowance is the bigger of two numbers, either your actual proven care costs or the official daily limit set by the IRS, which is around $420 a day. Any benefits you get to go above that allowance, that's what can get hit with taxes.
Let's make this real with an example. Let's talk about Mary. Her per diem policy paid her a whopping $146,000 for the year, but her actual provable care costs, they were only $18,250. Because the payout she got was so much more than what she actually spent, the IRS looks at that huge gap and says, whoa, that looks like income. And in her case, a jaw-dropping $127,750 is suddenly considered taxable. This is the per diem trap in action. It's a massive financial shock. So, that 1099 LTC form we talked about, it's not just a heads up, it's practically a treasure map of clues. And if you know how to read them, you can figure out your risk of an audit and a surprise tax bill.
Okay, so the form basically puts the ball in your court. Box 1 shows the grand total payout that the IRS now has on its radar. Then you have to make sure your benefits came from what's called a qualified contract. You also need a doctor's certification saying you're chronically ill. And finally, this is a big one. You absolutely cannot double dip. You can't deduct medical expenses that were already paid for by these tax-free benefits. That's a huge no-no.
And that chronically ill label isn't just a casual term. The IRS has a very specific medical definition. A licensed healthcare pro has to certify, within the last year, that you need major help with at least 2 of the 6 activities of daily living. You know, things like eating, bathing, getting dressed, or that you need supervision because of severe cognitive issues. If you don't have that certification, the tax-free status of your benefits could be in serious trouble.
And just when you'd think it couldn't get any worse, it does.
See, a tax bill on your LTC benefits isn't just a one-and-done problem. It can actually trigger a nasty chain reaction that slams into other parts of your retirement income. We call it the double torpedo effect.
This really just says it all, doesn't it? The real pain isn't always that first tax bill. It's the ripple effect, the way this new chunk of income messes with everything else in your financial world.
Just look at these numbers. Sticking with Mary's example, her adjusted gross income, her AGI, was a pretty modest $45,000. But after you tack on that $127,750 of taxable LTC income, her AGI explodes to over $172,000. That one event completely changes her entire tax situation for the year. It's a game changer, and not in a good way.
And here are the two torpedoes. First, that giant spike in income can make up to 85% of your Social Security benefits, which you thought were tax-free, suddenly taxable. Torpedo number 2, it can trigger something called IRMAA. Those are huge surcharges on your Medicare premiums. So, think about it. You're not just paying more income tax, your Social Security check gets smaller and your healthcare costs go up. It's a triple whammy.
Okay, I know that was a lot of bad news, but here's the good news. You are not powerless here. You can be proactive and protect yourself. So let's walk through a clear, simple action plan to tax-proof your benefits. Here are 3 steps that are absolutely vital. 1. Call your provider and confirm, in writing if you can, that you have a qualified contract, because non-qualified plans don't get this special tax treatment. 2. Become obsessed with record keeping. Save every single receipt for qualified care to prove what you spent. This is your #1 defense. And 3, remember that the IRS looks at this on a calendar year basis. Everything is calculated from January 1st to December 31st, so you have to track it all within that window.
And that really just leaves us with one last critical question you need to ask yourself. You bought that long-term care policy for security, for peace of mind. But have you done the homework to make absolutely sure it doesn't have a hidden and very expensive tax surprise waiting for you? Now is the time to find out.